Yes, good morning, guys. We were discussing about your tax rates yesterday's class. We went on to something called as companies tax rates. Yes, let's quickly revise before we go into special tax regime. We spoke about the fact that when you are a company, you will be having certain tax rates. For that, you need to split yourself into domestic and foreign. Domestic and foreign. If you're going to split yourself into domestic will have two categories. One is if your previous year 20 to 23 turnover is less than or equal to 400 crores, you will get a tax rate of 25%. Otherwise, you'll get a tax rate of 30%. If you are under a foreign company, the current year amendment comes and clarifies the tax rate to be 35%. But we went on to something called a special tax regime, where we came and said that there are two sections for you to focus upon. One is 115BAA and one is 115BAB. 115BAA talks about any domestic company choosing to move to this regime will be taxable at the rate of 22% plus a flat surcharge of 10% along with a cess of 4%. But if you are under a 115BAB bracket, you will have to satisfy certain conditions, more stricter conditions for you. First being you have to be a domestic company. Second is that you have to be into manufacturing. You have to be into manufacturing. For those to be satisfied, you will get a tax rate of 15% plus 10 flat plus 4% surcharge. This is what we discussed in yesterday's class. Yes. We're going on forward to the current special tax regimes called 115BAA and 115BAB. Now, before I go there itself, let me also clarify. Before 115BAA itself, there was some section called as 115BA also. There was a section called as 115BA also. Before this 22-23 order provisions came in, where before you were given 25% tax rate bracket, there was a section called 115BA, which used to come and say that if you are choosing, instead of taxing it at the old rate of 30%, you could have taxed it at 25% under 115BA. 115BA. That was what the provisions was. It was about 2019 Kamunadi. About 2019 Kamunadi, you were having a section called 115BA, which let you tax something at 25% if you choose to go for that. Yes, but no one went for it because the provisions were same as 115BAA, which means they were coming and saying that you have to choose 25%, but also let go of benefits. In which case people came and said, you know what, if I satisfy the turnover of less than 400 crores, I get all the benefits and I am also eligible for 25%. What is the point of having the section? Yes or no? After 115BAA came into picture, they came and said 115BA makes no more sense itself, because now you are losing benefits but you are getting a 22% tax rate. It's rather more beneficial. Yes or no? Yes. So when 2019 these provisions were brought in, they also amended 115BA because there were some cranky companies which chose for it. And the provisions with 115BA, BAA and BAB is that once you choose it, you cannot opt out. So therefore what happened is, people who were there in 115BA, first they had to give them an option that yes, we have brought in some new regimes. If you want, you can move on. If you want, you can move on. Yes or no? That's when what happened is 115BAA came into picture and they came and said, we will give you a special tax rate of 22%. 22%. The problem is that when you reduce something, you also gain something else. And therefore the sections were amended to say that if you are choosing to go for 115BAA, you will have to let go of certain benefits. Now, what are those benefits? This will change every chapter wise. And therefore I don't want to spend time right now because we have not even done the chapters. What I'll rather do is, I will only do the tax rates today. As we progress in the chapters and we complete the chapter, after we complete the chapter, I'll come and say these provisions are there for both. These provisions are not there for special tax regime. We'll work with that so that you can understand it better. Normally in inter-syllabus, what I'll do is I'll complete the whole syllabus, then I'll come back and do it. Yes, but now that you're in final, you should kind of know things. Yes, and therefore it will not be confusing for you. As in when we keep doing the chapters, I'll come and clarify which one to choose and which one not to choose. Right now that is not important. Yes or no? Yes. Now as we progress into the section, first things which you need to know is you are getting a benefit of specialized tax rate, lower tax benefits. But also note the fact that surcharge has become a flat rate right now. Yes, as much as you were doing default regime under individuals, I was still having a surcharge of same as 0, 10, 15, 25. Yes, but when it comes to this one, they came and said you have to put a flat surcharge of 10%. I don't care what your income is. So as one place you are earning something, at another place you may also lose. Because if you notice this carefully, domestic company would have paid a surcharge up to a maximum of 7% up to 10 crores income. Which means if you're having an income less than 10 crores, you are still losing somewhere because you're paying more surcharge. Correct, not correct? Yes, that is one problem with this section. Second problem, the section comes and says that any person who's here, once he chooses to be in the section, cannot ever opt out. This is one problem with this section where they come and say if you choose once you cannot play monkey business, don't come in, come out, come in, come out and all, not possible. In default regime also they give you once an opportunity. In an individual scenario also they come and say if you choose you can come inside and then once you can come out. Once you can come out. If you come out then there is no problem, you will remain outside. You will remain outside. Those kind of provisions are there, which means one time measure is available in 115 BAC also, but there is no such measure in 115 BAA and BAB. Choosing to opt in means permanent opt-in. Permanent opt-in. There is only one person who's allowed to move you out, which is assessing officer. Yes, assessing officer has been given arbitrary powers to come and say that if you choose to withdraw some conditions and you don't satisfy some conditions, I can push you out. I can push you out with the condition that if assessing officer pushes you out, you are never coming back again. You are never coming back again. Yes or no? Yes. So on a nutshell, Rahul, what is the provision coming and saying? I will give you specialized tax rates. You will have to let go of certain benefits. You'll have to let go of certain benefits. Once you choose to opt in, you will permanently stay here. You will never move out. You'll never move out unless and until assessing officer decides to do so. Unless and until assessing officer decides to do so. Clear enough? Clear enough? Yes. Now, this is what 115 BAA is. If I have to move you to 115 BAB, provisions are becoming a little more complex. Provisions are becoming a little more complex. Understand this carefully. I am coming and saying that Rahul, normally you would have been taxed at 25-30. In a specialized model also you would have been taxed at 22%. But I'm bringing in special provisions for you. I'm coming and saying you can now be taxed at 15%. Obviously, if I'm giving you certain extent of benefits, I will have you to satisfy stringent conditions. Yes or no? Yes. Now, what are the conditions, Rahul? First thing they came and said you should be a domestic manufacturing company incorporated after 1st October 2019. So the first condition I'm coming and saying start after 2019 because that is the date on which I brought the amendment. That is the day when I brought the amendment. 1st October was your ordinance date. It was your ordinance date. That is the date when the amendment came into picture. Yes. Second, they came and said, Rahul, if you start alone, it's not an issue. If you start alone, it's not an issue. You should have commenced manufacturing. You should have commenced manufacturing before 31st March 2024. 31st March 2024. Understand, you are writing exam for previous year 24-25, meaning any incorporation happening in the current year not relevant. It will then move to either normal or 115 BAA. Cannot choose for 115 BAB. Two conditions for you to satisfy. Clear enough? Yes. Now the moment you brought these two conditions, you are coming and saying that Rahul, if you're a manufacturing company, I'll give you 15% tax rate. Imagine companies like Reliance Industries working here for like 50 years now. Working here for 50 years. They're going to pay tax at 30, 25, 22 and all those things. Yes, for them this looks bad, right? They'll come and say, boss, this is unfair. I am here in this India for 50 years and I'm getting a higher tax rate. People coming just now are getting lower tax rate. They are happy, not happy? They are not happy. So what they came and said is, you know what, I will do one thing. I will create new company. I will create a new company and that company will get a tax rate of 15%. Yes, and therefore one big shenanigan which happens in India is whenever you give such extraordinary benefits, know what people will start doing? They will create a new company. But at the end of the day, you are running a same company now. So what will you do? You will create a new company and start moving all your assets. You will create a new company and start moving all your assets. Indirectly, what is happening? Same company, new bottle. Same company, new bottle, but beneficial taxes rate. Yes or no? Yes. To avoid all those, the third condition which came in and said is that the company which is getting incorporated should not be formed by splitting up or reconstruction. Should not be formed by splitting up or reconstruction. So I'm coming and saying, Rahul, if you decide that you will split up and reconstruct your business in order to get the beneficial, I will not give you the benefits. Now here is where the question is, Rahul, what do you mean by splitting up? What do you mean by reconstruction? What do you mean by splitting up, people? You're looking at models of demerger, meaning Reliance Industries will suddenly come and do what? They'll do a demerger, they'll create a new company and they'll push all their assets. They'll push all their assets and therefore they'll come and say, boss, you know what, new company, therefore lower tax rate. Not allowed because demergers are removed. What is reconstruction? Group structuring, like Hmm. Is it? So if you create a new company and the new company is going to run its own assets, run its own business. Yes. You can look at a scenario of amalgamation. You can look at a scenario of amalgamation or what we call as piecemeal distributions. What we call as piecemeal distributions. Piecemeal distribution basically means that I will create a new company. I'll create a new company. Month by month, I will slowly start moving assets. I'll slowly start giving employees. I'll slowly start moving contracts. Slow transfer. Slow transfer. Now, this is technically not splitting up because you're not getting code approvals. You're not getting code approvals, but you're technically doing a reconstruction. Yes, this is called as, I forgot the name. It's not slum sale. Slum sale is when you sell the business together. No, it is called an itemized sale. It is called as itemized sale, or in business terms, it used to be called as cutting off your king's crown. Yes, where they come and say that the major business which I have, that itself I will hive off. That itself I will hive off in order to disattract intention. Disattract intention. The idea was very simple. They moved all the assets, contracts and all slowly in order to other country. Please understand, reconstruction is a very generalized term. There is no right measure to it. There is no right measure to it. In a practical sense, an assessing officer can come and say that if you move 5 contracts from old company to new company, it's a reconstruction. It's a reconstruction. It is a burden on you to come and prove that you are doing a genuine business. You're doing a genuine business. Please understand, people, that at the end of the day, if you're going to be a part of the group, there will always going to be an intercompany transaction. There is no doubt about it. Yes. So therefore, there is a possibility that some things will move. Some things will move. That does not mean that you cannot come and say everything is reconstruction. That's not how it works. That's not how it works. But at the end of the day, the burden is on you, because please understand, I'm giving you beneficial provisions. And Supreme Court comes and says, when I'm giving you extraordinary benefits, the burden on proof is on the assessee. The burden on proof is on the assessee. Correct? Not correct? Yes. But here is where the comedy is. Here is where the comedy is. If you notice this carefully, the wordings come and say company should not be. As a smart CA, using this word, can you play around with the law? Can you play around with the law? Definitely yes. Yes. Understand, the wording says it should not be formed by splitting up or reconstruction, meaning I am only looking at year of incorporation. I'm only looking at the year of incorporation. Yes or no? Yes. Meaning, in the year of incorporation, I will not do a demerger. In the year of incorporation, I will not do a demerger. Second year, what I'll do, I'll start moving assets. I'll start moving assets. Will the condition get satisfied? Yes, because I did not form by splitting up. I did not form by splitting up. Yes or no? Yes. Small wording differences, people, but can make a huge impact. Yes, this is how M&A transactions take place. When advisors like you and all come in, no, they come and say the same thing. Boss, they told that you should not form by splitting up or reconstruction. I did not form. I was already there in existence. I just took over assets. And therefore my condition is still getting satisfied. Correct? Not correct? Correct? Not correct? Yes. Can it be done? Yes. Does it look like a tax avoidance? 100% yes. Can someone question? I don't think so. I don't think so. Yes or no? Yes. These are small ways to work it out, people. Yes or no? Yes. But then brings in the 4th number condition. Here is where they played a little smarter. They came and said the company should not use plant and machinery which is already used. The company should not use plant and machinery which is already used. What do you mean by this, people? I should not use any second-hand machineries. Now, where I could have come to the second years and given my assets to them. I would have satisfied condition number 3. But I'm now stopping condition number 4. Because condition number 4 is now coming and saying that you should have not given your assets to someone else which is already second-hand. Indirectly coming and saying you should not use existing assets, meaning existing business should not be transferred. Yes or no? Yes. But then therein came in conditions of exceptions where they came and said, I am okay if you use second-hand machinery, because at the end of the day, you cannot come and say every asset cannot be given. Yes or no? So they came and said up to 20% allowed. Up to 20% allowed. Meaning, if I'm giving assets to you, I can still give you assets as long as the value is less than 20%. Now, here is where the question is, 20% of what?
The company's
Which company? Old company, new company? It is 20% of the used allowed in the current plant and machineries. Meaning, if I have a plant and machinery of 100 crores, my 100 crores like 20 crores should not be used. Yes or no? Yes or no? Now here begs the question. Here begs the question. They say 20% of plant and machinery. 20% of plant and machinery, and they're saying out of the total plant and machinery you have. Now here is where my question is. Rahul, total plant and machinery means as per income tax or as per Companies Act? I don't know. It is not given. Yes, here is where the bigger problem is. They come and say you should not use more than 20% of the plant and machinery as used assets, but they have not clarified whether value should be as per Income Tax Act or value should be as per Companies Act. No, it doesn't. Yes. Now here is where the problem is. I don't know whether you have to use Companies Act thing or income tax thing, because understand, if I have to play around with this, Companies Act gives you better benefits, because in Companies Act you can do what depreciation you want. There is no basis. Income tax may have a WDV method, whereas when income tax is coming and telling you how to do it, but Companies Act does not give you any methods. They come and say whatever is better for you, you can do it. If I want, I can depreciate all the assets today itself. Correct, not correct? Correct, not correct? What can I do? I will bring all the assets from another company. I'll bring all the assets from another company and depreciate it off today itself, meaning my value of assets will become possible. That is from the old company, right? I'm talking about the new company. How does it matter? See, understand, when you bring it to the new company, the provisions come and say that when you bring it to the new company, it's brought at the purchase price. I was coming to that. So let's put it this way. Let's put it this way, people. Understand, at the end of the day, what is going to happen is, if you are under old company, what is your tax rate? 25%. If you are in the new company, what is the tax rate? 15%. Which means in the new company you like to keep more profits, or old company you like to keep more profits? In the new company you like to keep more profits, yes or no? Yes. Now imagine a case where I have a plant and machinery. I have a plant and machinery worth 100 crores. Worth 100 crores. Depreciation will be granted by old company. Yes or no? But I want to use this asset for my, what will I do? I will transfer it at, I cannot transfer it at zero. I transfer it at a very less value. Let's say probably 50 lakh rupees. Probably 50 lakh rupees. Now, if you understand depreciation concept properly, what happens? Only 50 lakhs will be dropped out from the block. Only 50 lakhs will be dropped out from the block. Yes or no? Yes. Which means the old company will still claim depreciation on the full 100 crores. New company bought it for 50 lakhs, which means new company's block of asset is 50 lakhs. It has its other assets also. It has its other assets. Now the worth of the asset is 500 crores, 100 crores, but he now has the asset for only 50 lakhs, and he has other assets which he'll value at 200 crores, 300 crores, 20% condition. And both the companies benefited, because old company is continuing to claim depreciation when they don't even have the asset. And new company is offering more income because they're okay, they're going to pay tax at 15%. Yes or no? Yes or no? These are all methods to M&A, people. Simple. Yes, these are all methods where you can suggest your clients to make more profits illegally. But there is nothing illegal because you're following the law. Because you're following the law. Yes or no? Yes or no? Yes, these are all small methods, people. Can you be doing it? Definitely yes. There are 101 ways to avoid things. Yes, you just have to look at it differently. That is the only point of here. Yes, but the one thing which you need to know critically here is that in this section they are using the word use. They are using the word use. I'll show you probably an act, and you tell me what exactly is the difference which you notice. I'm going to use a similar section. There is a section called 35 AD. Any idea? Specified businesses. Yes, you will notice the same line somewhere. If you notice section number 2, notice section number 2, what does it say? The section applies to specified business which fulfills all the following conditions. Point number 2. It is not set up by transfer of specified business of machinery or plant previously used for any purpose. You see the word? What is the word using? What was the word there? What is the difference, people? What is the difference?
Not use and purpose. It is becoming more sensitive. Throughout the life of the new company, it shouldn't use this thing, use machine.
Understand a very subtle difference in one small word. It says it should not set up by assets previously used, and here it says it should not use any previously used assets. What does it mean, Rahul? There you should not create the firm by create the business by old machineries, which means after you create second year you can bring old machinery. You will still satisfy conditions. You'll still satisfy conditions. But here is a case where they come and say you should not use any previously used machinery, which means now I'm coming and saying 20% condition should be satisfied every year. 20% condition should be satisfied every year. Every year I will come and verify whether you are using old machinery, and if you do so, you are violating condition. You are violating condition. Small subtle difference, but a huge impact. Because now assessing officer has the power on a yearly basis to come and tell you to verify whether how much is your used assets and how much is your new assets. To the extent of the used assets, he will check for the condition of 20%, and if it gets satisfied, he will say, I'm sorry, you're violating conditions, no more benefits. No more benefits. A small subtle difference. Ade Mari, if you notice on the top, it says the business is not formed by splitting up or reconstruction, meaning now I'm coming and saying splitting up and reconstruction only to be satisfied in the year of incorporation. After that, I don't care. After that, I don't care. Yes or no? Yes. If you notice this carefully, that's what the point is. Meaning, today, if you do not bring your assets from another company, you may satisfy condition number 1, but you may still end up crossing condition number 2, because you should satisfy this condition on an yearly basis. Either if you go to 35 AD or 10 AA, SEZ or specified business, in both the places they use the word formed and set up. They use the word formed and set up, and therefore there is a big loophole there. What is the loophole? When you create the business, you create it with new assets. Second year, what will you do? You will bring all the old assets. You will bring all old assets, and you will come and say, boss, condition satisfied because you only asked me to look at formation. This is not formation period. This is your subsequent years, and therefore you can do whatever you want. You can do whatever you want. People in 35 AD always come and imagine that, Rahul, it's a stringent condition. Nothing stringent about it. You can play whatever you want in the second year. You just have to play around in 1 year. You have to just play around in 1 year. Second year, you can do whatever you want. You can sell all your assets from the old business and claim 101% deductions. No one will care. No one will care, because formation is done. Formation is done. Small English differences in the act can make huge impacts, people. Yes, the way people avoid taxes, I tell you. This is the ways to do it, and no one can dispute it also, even though it is completely tax avoidance. You cannot do anything about it, because the law clearly comes and says there is no ambiguity here. There is no ambiguity here. There was no intentional defeat, because you only came and used the word set up and formed, and I did the condition satisfied. Yes or no? Yes or no? Yes, big impacts, but extremely important. Extremely important. Clear to go? Clear to go?
Basically used for any purpose. Totally used by the not exceed 20% of the total value of plant and machinery used by them.
Correct. It doesn't. I was coming to that. Okay, that's my hidden question. We'll discuss. I'll bring to that. There is some very, very subtle difference here. I have a special question for you people. Let me not spoil the fun right now. Yes, I'll bring that question up for you. You have some questions to solve with me, no? That time we'll figure it out. Yeah. Point is, right now, this is what is coming and saying. It says that you should not use old plant and machinery. You should not use old plant and machinery any year more than 20%. There is also an additional condition which is given here, that, Rahul, when I say used plant and machinery, I only mean plant and machinery used in India. Meaning if you import assets from outside India, even if it is a second-hand machinery, it is assumed to be new machinery. It is assumed to be new machinery. In whole of the act, anywhere where they use this condition that you should not use old plant and machinery, they always come and use the fact that you can import assets from outside India. There is only one exception to the rule. In this whole income tax, there is only one place where they come and say a foreign imported asset is also called as used machinery. Any place? Very good. It is in additional depreciation. In additional depreciation, they come and say that when you bring in assets from outside India, that is also considered a second hand only. And there you will only get normal depreciation. You will not get additional depreciation. When we do that chapter, you will understand. But right now, the provision is any assets which is used in India should not be given to the new company. Clear enough to go? Yes. There are some additional conditions. Now, those are not very important, but I'm just showing it to you quickly. What are the additional conditions, Rahul? The additional conditions come and say, first of all, when you're using the word manufacturing, they also brought in another additional stringent condition. The condition come and says the company should not be into any business other than manufacturing or its incidental activities. Now this provision was more like a safety measure, I would come and say, right? Basically what happened is some people would come and say, what, I will create a company. I will create a company. In that company, 99% of the company is doing trading job. 99% of the company is doing trading job. 10% like what they'll do is they will bring some raw materials, they'll make some small products and they'll sell it off. Like subcontracting and all those things. And they used to come and say, Rahul, you never came and told me that I should not do anything other than manufacturing. So what I did, 10% of my revenues from manufacture, everything else is sale business. And they came and said, I want 115 BAB. To clarify that I am only giving these provisions in case you incorporate a fully loaded manufacturing entity, they came and clarified that the entity should not be doing anything other than manufacturing activities. At best, when I say anything other than manufacturing, I do not mean that you cannot do anything at all. It means that if you want, you can do some incidental activities to it. Like for example, if I'm making raw materials into finished goods, obviously it is my job to also sell the finished goods. I cannot come and say, no, I will only manufacture and keep it in my factory. I will need to sell. And so incidental activities to that is permitted. When I'm selling my raw materials into manufacturing finished goods, I will also have to take care of warranty, which means repair expenses and all is also my job. Yes or no? Now that is obviously not manufacturing, but it is still incidental. So those things are permitted. Yes or no? Yes. But here brings in the question. When they said that, Rahul, you should not use any business other than manufacturing, they are technically stopping you from doing passive income also. They're technically stopping you to do passive income also, which means tomorrow if you decide that you will buy mutual funds, sell mutual funds and get money out of it, will it term as a default or will it not term as a default? Why? Just because you classify into OS. Up to today, if you decide that you will rent out one of your factory building,
Still, it is not a business.
see, understand, is this a manufacturing activity? No. Is it incidental to your activity? Apo, can you come and say that it's violating condition? No. Why? Because
It's not my business.
very good. Understand, a small line of difference comes and says you should not be into any business other than these activities, which means you can still do incidental activities. The only request is it should not end up becoming your business nature. If it is an incidental thing which is going to be classified under IFOS, I am still okay. Correct, not correct? Which means that is perfectly permitted. But don't end up in a scenario where somehow they end up becoming your business. You start making huge revenues out of it, you're gone case. They will take away your conditions. Again, a very subtle difference. They are not coming and saying don't do anything else. They're just saying don't do anything else as a business model. Are you clear? Yes. So small tradings and all happening in the company, making profits out of it, putting money in FD and all those things are still permitted. The only problem with this is that income tax came and said, boss, if you don't do any activity which is incidental, I am not going to give you 15% and all. The rate is now jumping to 22%. Meaning income tax comes and says, Rahul, if you derive income from manufacturing activities, then I will give you a rate of 15. But if you derive income from anything which is not manufacturing or incidental activities, rate becomes 22 plus 10% plus 4%, same as 115 BAA. Yes or no? No. They came and said, Rahul, this rate will be applied on the gross income. Meaning now they are coming and saying, I will tax full revenue, no expenses allowed as deduction. In simple words, they are coming and saying, if you end up in a manufacturing income, it is flat 15 with 10 plus 4 on net income. But if you derive any incidental incomes, it is taxable at 22 on gross level. Expenses are fully denied. For deduction purposes. Are you clear? Third, they came and said, Rahul, when you are creating a company like this, I am knowing that, Rahul, I would like to put more income in 15% company and keep lesser income in 22% company, which means one model which I'll always prefer to do is I will act as a conduit now. I'll act as a conduit now. What I'll do, I will make all manufacturing in old company. I'll make all manufacturing in old company. One process alone, I'll leave it. And I'll transfer all these assets to my 115 BAB company. Yes, and then one extra process I'll do in that and I'll sell it off from 115 BAB, thereby ensuring that most of the profit sits in 115 BAB. Group level, you make more profits. Taxes are lesser. Yes or no? For this to avoid only, we have this very stupid chapter in income tax called as transfer pricing. We have this chapter called as transfer pricing, where we are coming and saying that Rahul, you will move income from one company to another company in order to ensure that the taxes are lower. Understand, transfer pricing normally applies on international transactions. This is a domestic transaction, and therefore in transfer pricing itself, we have a concept called as SDT. Specified domestic transaction, where they come and say that if you are going to enter into transactions from a high tax entity to a low tax entity, then also you need to check for transfer pricing. So they came and clarified that 115 BAB company is also going to be termed as SDT entity. Meaning if you enter into transactions more than 20 crores with the new company, you will have to apply transfer pricing regulations and have to prove that the transaction is done at arm's length. Transactions are done at arm's length. Yes or no? Yes. Condition number 7. They are coming and saying that, Rahul, when you enter into any such transaction between group companies, and it is clearly identified that the transaction was done only for the purpose of reducing taxes, income tax came and said, where the assessing officer determines transaction was done with something called as closely connected persons. In order to reduce taxes. Whatever is the profit which is unreasonable, in the hands of BAB company, whatever profits which is unreasonable in the hands of 115 BAB company shall be taxed at 30%, right, flat, plus 10 plus 4, 30 plus 10 plus 4. So they came and said, Rahul, now I'm bringing you the third rate. Where if you are entering into such transaction where the assessing officer can clearly determine that you have done it only for the purpose of evading taxes, the rate now jumps from 15 to 30 directly. The idea is I'm coming and saying I'll tax you at the original rates. The same rate which the old company would have paid. The fact is that old company may be taxed at 22% also or 25 also, but you will end up paying tax at 30%. Yes or no? Yes. Next.
He says ALP is 50. So on 40 he will charge me 30.
Obviously, because to the extent of 10 it was not unreasonable. Yes. Condition number 8. Problem with income taxes, we started using the word saying that company should be into manufacturing and production. The problem with income tax is income tax never defined what is manufacturing or production. Yes, and therefore there were various interpretations to it. I'll give you a simple example. Take a company where the company is into the business of taking the marbles and cutting the marbles into smaller pieces. Question: manufacturing, non-manufacturing? It is manufacturing as per Supreme Court decisions. The idea was that they came and said, boss, and product changed its characteristics. When they cut out into smaller slabs. They were used for different purposes as compared to the bigger slab, and therefore they gave the benefit of calling it a manufacturing entity. These are all conditions or case laws which were there from prevalent times when they were claiming additional depreciations, when they were claiming some chapter 6 reductions and everything. Yes, and so what happened is the moment they introduced this and they came and said company should be in the business of manufacturing, companies like this which were cutting slabs were coming and saying I want 15%. I want 15%. I'll give you condition number 2. Imagine that you are a company who takes papers, makes into book. Question: manufacturing, non-manufacturing. Manufacturing, non-manufacturing. They called it as manufacturing in Supreme Court again. Although you have done nothing, you have just put a label on the back and front. At the end of the day, it's the same thing only. Paper is the paper. The only thing which has changed is label has come on the back and front. It's become a book now. Rather than looking at a loose sheet, it looks like a combined binded book. Does it change the characteristic? No. But Supreme Court came and clarified it is also manufacturing. Now, yes. Now all these companies started claiming that they are a manufacturing entity and started paying tax at 15%. Income tax at day. What the hell are you doing manufacturing in this? Yes or no? So what happened is income tax took all the decisions which were there. And then decided amongst themselves which one should they call as manufacturing and which one they should not call as manufacturing, and thereby came in an additional condition where they came and said, although Supreme Court may have come and told that these activities are manufacturing, for the purpose of 115 BAB, I am not going to term them as manufacturing. What are the items, Rahul? I'm coming and saying any kind of development of computer software. Yes, one of the decisions of Supreme Court came and said that if you develop computer software, you're technically manufacturing. You're only doing coding here. There is nothing great happening. But there was a Supreme Court decision which came and said it's manufacturing. So 115 BAB clarified, I am not going to give you a manufacturing, because technically the moment you do this, Tata, Infosys, everyone becomes manufacturing and everyone will start claiming 15%. Meaning motto software sector is now 15. They said, I'm sorry, not doing anything. You are only taxable at 22, 25 or 30. Don't claim any additional benefits. Second, I don't understand. At a certain point of time, courts came and said that, boss, when you go into the mine and you take out coal and everything, it is a manufacturing. You just dug up something. I don't know how it became manufacturing, but the courts decided, and therefore income tax came and said, I am sorry, not permitted as manufacturing. You will have to treat it as service sector. Then conversion of marble blocks into slabs. Sonnamari. Take a bigger thing, cut out in pieces. That will also not be manufacturing. Next, bottling of gas into cylinder. So you take that on the wheat level LPG cylinder. Adela, if you put gas, it is manufacturing as per codes. Income tax said nothing doing for 115 BAB. Yes. The one thing which I'm also trying to tell people is that all these conditions which you see may have been excluded in 115 BAB, but has not been done in any other section. Which means if you do any of these businesses under any other section, they will call it a manufacturing, and you can claim higher benefits. A very classic and a very good thing you can do in additional depreciation cases, because all these businesses can claim additional depreciation because they are termed as manufacturings. Yes or no? Yes. Next, any kind of printing of books or production of cinematographic films. So when you print books and everything, those are all called as manufacturing. And then any other business as may be notified by CG. Today nothing has been notified. This is a safety measure, because suddenly court will bring in one more judgment and they'll come and say this is also manufacturing. That day they'll use this and they'll come and say, I'm sorry, not bringing it. Additional specified conditions to you. Clear, not clear? Yes. Now, Rahul, if you do all these things, then only you are eligible to claim 115 BAB and be taxed at the rate of 15%. Here is where assessing officer comes and says that if you violate any condition, I have the power to come and say that you will not be eligible for 115 BAB and I will throw you out. Now here is where the problem came. In 2019, when they brought the amendment, they came and said that if you are not eligible for 115 BAB, you will be reverted back to original provisions. People who came and formed a company were claiming 15% but violated condition. Assessing officer came and said you are violated, so therefore move back to original and demanded that they pay tax at the rate of 30%. Now here is where the assessee went and said, sir, I understand that I violated 115 BAB. But even if I violated 115 BAB, I would have still been eligible for 115 BAA. You reverting me back to 30% is very wrong. At least make me 22. Assessing officer came and said, I'm sorry, not doing it, because the provision says I have to revert you back to normal provisions. Looks like a lacuna. Yes or no? So what happened is next year an amendment came, and the amendment came and clarified that if a person violates 115 BAB, it does not mean that he'll automatically move to normal. You will now give him an additional benefit to grant 115 BAA. If he chooses, he can go to 115 BAA. If he chooses, he can go to 115 BAA and he can go from there. He can go from there. Here is the question. Rahul, I am already under 115 BAA. I want to move to BAB. Can I do it?
No, because they are a old company.
Why would you be under 115 BAA? Because you were either an old company, you violated conditions, or you're not satisfying any of these conditions. Apona, can you move into the new company? Definitely not possible. Definitely not possible. Except for one scenario. Except for one scenario. Income tax came and said that Rahul, this 115 BAB company, which is being taxed at 15%, it's not mandatory that it will be living forever. At a certain stage, it may decide to amalgamate. At a certain stage, it may decide to amalgamate. Now understand, if this company ends up amalgamating with another company, you should be able to give this benefit to the other company also. Yes, and therefore this company came and clarified that if you are going to amalgamate yourself to another company, I will continue to extend these benefits. I will continue to extend these benefits provided the new company also satisfies conditions. The new company also satisfies conditions. So therefore, if you satisfy the conditions in the new company also, I'll give you the 15% benefits. Yes, which means if you amalgamate to another company, you should ensure that this company is a predominant company. This company is a predominant company. In that case, you can come and say, yes, the company is satisfying all the conditions, therefore you are permitted for 15% brackets. 1 second. Sorry? Understand, the other company is not being formed by reconstruction because you are changing from 15 to 15. So there is no intention of tax avoidance here, right? If a 22 moves into 15, then it's reconstruction, but a 15 moving to 15 is not reconstruction.
What are we trying to say?
We are trying to say that if you create a new company, let's say for example, you decide that Vodafone is there at 15%, Idea is there at 15%, you decide to amalgamate both. That is what the idea is. Yes, you should not end up coming and saying that just because amalgamation happened, you do not satisfy conditions, so I'll withdraw the exemption from you. You will still permit the exemptions. You will still permit the exemptions. Or it can be a model where I'm coming and saying that there is a new company created, just now created, has done nothing business. But this company is doing 15% business. When you amalgamate, can you take a condition satisfaction? Kind of yes. Kind of yes. That is what my feeling is. That is what my feeling is. Although one assessing officer can also come and say that the new company which is created is now created after 2024. And therefore they may choose to deny the benefits. They may choose to deny the benefits. That is a way of thinking of it. That is a way of thinking of it, but it is not clarified. It is not clarified. I would normally come and say that when this company was at 15%, amalgamating also does not change the fact that it should be at 15. Yes or no? And therefore I should still be permitted to grant that additional benefit because there is no misunderstanding of tax avoidance here. Yes. So from my perspective, I would still come and say it is not reconstruction or splitting up. It's not reconstruction splitting up. So therefore I would still permit the benefits, but yeah, it's an open area for discussion. We don't know what the right answer is. Clear? 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 Some smaller conditions which are pending right now. One is that they have brought it here. It says the company should not use any building which is previously used as a hotel or convention on which you had claimed section 80 ID. Now, for those who don't understand 80 ID, forget it off. Forget it off. Old times, you're talking about 2007, 2006 and all, there were extraordinary benefits granted to various sectors. Yes, there was another chapter itself called as Chapter 6L, heading number C. Chapter 6L, heading number C, where they came and said if you enter into some specific industries, I will grant you 100% profit benefits. 100% profit benefits. One of them was 80 ID, where they came and said that if you buy a building and you use it for hotel business, 100% of the profits are allowed as deduction for the first 5 years. For the first 5 years, extraordinary benefits were granted to you. Ideally, all those have become a part of sunset clause right now, which means none of the benefits are extended right now. It is not part of your syllabus also. But they're just clarifying that if you're going to use a building, don't use a old used building which is used for earlier deductions. Absolutely. If you come and ask me, I don't see a reason why they brought this amendment also. Right? Because you're talking about benefits granted 10 years ago. And even if he brings it and uses it, what is the big deal? I don't understand. Yes. But for some reason they had this condition and they brought it, and therefore we have to follow that also. What I'm going to do is I'm going to read everything from top to down again. Yes. And we'll see if you understand everything or if you have any confusions. Condition number 1, it says company should commence manufacturing or production of article or generation of electricity on or before 31st March 2024. One thing which I wanted to clarify to you people is that when you enter into income tax, every time you see the word manufacturing and production, electricity is assumed. There is no such section in Income Tax Act where they use the word manufacturing but don't use the word electricity. Because in all practical sense, income tax comes and says electricity generation is as good as manufacturing. So wherever you see the word production, Assume that there is also electricity. Assume that there is also electricity. Next, company should not use any plant and machinery previously used for any purpose in India. Previously used for any purpose in India. More than 20% of the total value of plant and machinery. Like I said, I don't know what 20% of total value means. Is it as per income tax or as per Companies Act? Subject to interpretations. Subject to interpretations. Second, plant and machinery imported outside India shall also be treated as a new plant and machinery. Next, business should not be formed by splitting up or reconstruction of a business which is already in existence. Formation is a concern. Futures are okay. Futures are okay. Next, company should not use any building previously used as a hotel or convention for ATID. Then we also discussed about the fact that company should not be engaged in any business other than manufacturing. Incidental incomes are permitted. Incidental incomes are permitted. However, the following conditions which you already satisfied should not be considered as manufacturing, and therefore you will not be eligible for benefits. Company will not claim certain benefits or deductions, which I told we will discuss subsequently. Next, where the company violates any of the above conditions, the options exercised would become invalid for the year of violation and all the subsequent years. However, where the violation of condition C to E is happening, the company may choose to opt for 115BAA and get a benefit of 22%. Next, where an amalgamation takes place subsequently, the amalgamated company can also claim the benefit of 115BAA if the above conditions remain to be satisfied even post amalgamation. You continue to satisfy your conditions post amalgamation, I will still grant you the benefits. Next, if the AO is of the opinion that owing to the close connection with any other person, the company has derived more than ordinary profits from the business transacted with such person, the AO shall compute the profits of the business and the excess profit shall be taxable at the rate of 30%. So which means, like I said, if you're going to do a transaction with him for 50 rupees, where you know that the transaction should only be for 10 rupees, the differential 40 will become taxable at 30%. Taxable at 30%. Yes or no? Yes or no? Yes. Next, exception. In case of a transaction value exceeding 20 crores, the provisions of STT will be applied and the profits will be determined by the TPO. Yes. So now they're coming and saying where the transaction exceeds 20 crores, the normal assessing officer does not have authority. The authority remains with transfer pricing officer. You will have to get an arm's length transaction transfer pricing direction order from TPO. Then only you can move forward. Further discussion on this when we do transfer pricing. Next, a company shall opt for the provisions only if the same is exercised in form number 10 ID on or before the due date of filing the first returns of the company. Meaning they came and said, Rahul, the first time when you file an income tax return, you should have chosen that time itself that you want to go for 115BAB. If you choose, then you get the benefit. If you don't choose, you don't get the benefits. Now there was a big amount of discussion on this when it was initially brought in, because what happened is they came and said that company should be formed in 2019 and could commence manufacturing anywhere until 2024 also. So at certain point of time, what happened is a company got created in 2019 but never started business and did not know whether they'll satisfy conditions or not satisfy conditions. But here is where what happened is they came and said that you have to opt for this in the first of the returns. Now here is where the problem happened. Companies incorporated did not start manufacturing. 2020 they filed their first returns and chose to claim 115BAB. Assessing officer took the return, denied the claim. Why? Because they said when you have not even started manufacturing, how do you know that you will satisfy conditions? How do I know that you will satisfy conditions? Therefore, I cannot grant this benefit to you. You are violating the condition and therefore you will go back to BAA. Now here is where the assessee is coming and saying, sir, I understand what you're doing. Imagine next year I start manufacturing and I satisfy all the conditions. Then I should be granted 15. In that case, current year you taxing me 22% makes no sense. At the same time, when you are choosing to say that I am violating conditions, I am denied from coming back to BAB. And therefore for me the conditions are completely useless. Because where one point of time you are coming and saying that I can manufacture up to 2024, meaning you are giving me 5 years to start manufacturing. Here you are coming and saying me that I should start manufacturing next year itself, otherwise you will not give me the benefits. Yes or no? See, when two things are contradicting each other, problems start, and then you have to start playing careful. It is like I don't know what the answer is right now. Yes, because as an assessing officer, no one will like you to be taxed at 15%. They will like everything to be taxed at 30, 25 and 22. So they can play around with anything they want. Sometimes when you put in conditions, you should also come and think about whether it's practically possible also. Yes, and this is a classic case where it is not practically possible because assessing officers have been denying claims. All these cases are right now under court decisions. and they have come and told, boss, I don't know what to do. The person has denied me my claims and I'm not able to claim any more benefits. I'm not able to claim any more benefits. Give a court decision. Give a court decision, and everything is pending with courts right now, and courts is trying to figure out what to do. Yes, here is where the problem is. You went to the court. You went to the court asking for 15. Asking for 15. But as you keep going to the court, you know court is not going to pass the order tomorrow. They're going to take their sweet time. Yes, meaning for that interim period, what are you supposed to do? Because if an assessing officer has passed an order saying you're violating conditions, they have asked you to move back to BAA. They've asked you to move back to BAA, which means you don't have an option to choose BAB. Because if you do that in the return, they will come and say, I told you to do it and you're violating condition, you're technically doing a illegal thing, which means they will levy penalty on you. They will levy penalty on you. So which means you have to opt for tax under BAA. But if you choose to opt for tax for BAA, tomorrow if the court comes and says, yes, you can do BAB, you can do BAB, do you think you'll be given the option to revert back and change all the years? Then assessing officer will come and say, boss, when you itself offered at BAA, what am I supposed to do? What am I supposed to do? Now I'm not going to grant you the benefit of going to BAB. Yes or no? Because at the end of the day, it's a self-certification. When you self-certified, you self-certified as BAA. You self-certified as BAA. Why should I give you BAB benefits now? Correct, not correct? Correct, not correct? Big problem, people. Yes, it's all about playing politics, nothing else. Clear politics going on here. But that's how it is. That's how it is. Ideally, in all these cases, no, you should have never waited for an assessing officer order. You should have directly filed a writ petition. Understand, people, if you go through a normal route, you know it will take time. But if you file a writ petition, they have time-bound activities, which means they can give you benefits in a matter of year also. By the time the next return comes, you know what the answer is. But these are not things we will suggest. Obviously, because we want money, no. We will not suggest writ petition and all. We'll come and say, sir, normal appeal. Let's take our sweet time. Because what will happen for the second years also, you will need money. You will ask them to, sir, come to me. I will help you file another appeal. I'll help you file another appeal. Every appeal you will charge 2.5 lakh rupees. I'm talking before fees. Yes or no? Yes or no? That's how it works. We will never give the suggestions to them, but yeah, at the end of the day, you have to also generate revenue, right? Because if you're a manager sitting in a big four and all, if you don't generate 1 crore, they will not give you salary. You know how it works, timesheet and everything. I'm not going to deny it. You know what the hard reality is here. Point is, as a person, you should know what is happening. These are all plays for you to play, people. Yes, these are all games for you to play, and you can always play smart around it. You just have to be mindful of what you're talking about. Clear? It's not 18-19, right? 2021. It started manufacturing after 19. So 2021. See, that's true, but then the problem what will happen is the moment you do that, assessing officer will come and say that I have violated all the conditions. When I violated all the conditions, I have told you that you have to revert back to BA. Yes, so which means what will happen is if you do that, then you are clearly coming and saying that you are violating in court order, assessing officer order. While you can use the defense that it is pending under appeal. You can use that defense, but at the end of the day, it is not something which he is going to agree to. Yes, because at the end of the day, he will make disallowances. So which means you are like voluntarily provoking a disallowance. Right? Because then he's going to hit demands and he's going to hit interest, penalty, everything he wants in life. Yes, especially when the section is very clear to come and say when the assessing officer has decided, you have to choose for it. Yes, that time you cannot say otherwise. That is where the whole problem is. You may be under appeal, that's okay, but at the end of the day, when it's told that you have to follow, no doubts about it. Right? So you can do it. I'm not denying it. Technically, that is what would be the best recommendation to do. But at the end of the day, you're invoking issues. Right? Because he has clear authority now come and say that you are violating conditions and he can put you in jail for that, straightforward. No doubts about it. Clear enough? Yes, what are the last items, Rahul? It says once the company exercises the option, it can subsequently opt out of the, it cannot subsequently opt out of the option for his lifetime. Now, one thing not so important from exam, but just to clarify to you, this line which you see above, where the company violates any of the above conditions, the option exercise will be ignored for the current year and subsequent years. The funny thing which happened is this same line is also there in 115BAA. Now think about it and tell me, in 115BAA, is there any of these conditions? What is the only condition in 115BAA? The only condition in 115BAA is you should not claim the benefits. You should not claim the benefits. Other than that, there is no condition. The conditions are not there itself. They simply come and say you should be domestic company and opting for the form. Other than that, there is no condition except for coming and saying you should not claim the benefits. Now, here is where the funny thing is. If I am a cranky officer, and I want to screw your life, what will I do? Imagine you file a return. In one of the return, you make a mistake. Let's say, for example, you by mistakenly claim 35AD. I have two options. Option number one, I can come and say, you should have not claimed 35AD, therefore I will disallow. And I will still keep you in 115BAA. Option number two, I'll come and say, I will say that you have violated all the conditions, therefore you are not permitted for 115BAA, revert back to the old provisions. And the power given to me is that once I revert you back to the old provisions, it is lifetime gone. This is the kind of politics I can play with you. And am I permitted to do it? Yes. Because the section comes and says where the person violates any condition given in the section. Now, this was also a condition that you should have not claimed, but you claimed, which means you violated the condition and I have the power to bring you back. Understand, I can do the same thing for BAB also. Because in BAB also they come and say the same thing. Where you violate any of the conditions, I can revert you back to old laws. Imagine a case you are in BAB and you by mistakenly claim 35AD. I should do what? I should deny 35AD and give you 15%. But I'll come and say that you violated conditions, which means I will deny you BAB. You will say, okay, give me BAA. I'll say you violated BAA also. Because there also you cannot claim. So therefore, I will now come and ask you to move directly to 30% bracket. Yes or no? Yes. A very poor drafting of law if you come and ask me. Very poor drafting of law because you never needed this condition in BAA. But there is unnecessarily there. The only problem what happened is that when they were drafting both the sections, they just copy pasted. And by mistake, they forgot that when they're copy pasting it from BAB, they should have not put the BAA, but they somehow put it. If you technically ask me, that line has no relevance in BAA. Because you cannot enforce it itself. Can you enforce it? You cannot enforce it itself, which means there is no problem of you not having the line also. But somehow giving the line is now giving arbitrary powers to assessing officer to come and say that if you don't put your computation of total income properly also, I can move you back to normal regime. Now it's a different story that in a court decision, court will come and say you could have denied the claim and given him 22%. But until that time, I have the powers to screw your life. Yes or no? Yes. And I have now the powers to go and pass an order, put a demand on you, get interest, get penalty, everything from you, and I will come and pass my revenue judgment. Which means my targets are achieved. Because I have passed an order with that target and I'll go to my superior and come and say, sir, I have got so much target from the company. Give me my promotion. By the time the court decision comes back, you're already promoted. Correct? Not correct? Possibilities are endless, people. When you want to play, you can play whatever you want. Things like this are just be careful about. When we go to updated return, I'll probably come and tell you that is one of the worst decisions to do. Filing an updated return is one of the worst decisions to ever do in life for two reasons. Reason number one, updated return comes and says the moment you choose to do an updated return, whatever extra tax you're going to pay, you have to pay 125 and 150% on it. Worst decision. No one would like to pay so much. Second is the updated return comes and says the moment you file an updated return, assessing officer now has been given extended powers to reopen your assessment for 12 months. So, you first pay tax, then he opens up your return also, and he is assessing other things which you would never normally would have not assessed. Right? Updated return came in as one of the worst things to bring in because they came and said that first of all, you cannot use updated return for my benefits. You can only use it for department benefits. In that department benefit also, you have to pay 125 and 150%. In that also, they will open assessment and they can do anything else also. You cannot file updated return. See, here's the thing. How did you make it 100 or 1000, whatever it is? See, that's what I'm, see, you're being in hypothetical scenario. You're coming and telling me that you had loss and you will convert it into 1000 rupees income. Now, it's not like income will magically appear. You should have done some transactions in that year. Correct, Ra? So the point is, if you revert 35AD into normal, do you think you will only end up at 1000 rupees? let's hypothetically assume also, because any company you're talking about is going to have a huge reduction from 3580, right? And when it's going to have that level of deductions, you're technically talking about numbers in crores. So which means your income is going to jump in crores, your tax is going to jump in lakhs, and you're going to pay 125 of that.
One more thing is that assessing officer has wanted a 80. Assessment open, I cannot pay update. After assessment open, I cannot give update.
Updated return provisions are only applicable till 30th June if you honestly come and ask me. Because 30th June is the date when he picks up yours for assessment. So which means if you file an updated return by 30th June, you are safe. But if you file anything after 30th June, there is no point. Because either you were not picked up for scrutiny and you unnecessarily wasted your time, or you got picked up for scrutiny and updated return is not permitted. That's what I said. No, when we do updated return, I'll come and tell you. The stupidest of the provisions ever introduced, they brought it as if they have done magically wonders. But when you actually get into the nitty-gritties of it, updated return is one of the worst things to do, I tell you. Yes. And for some reason, I don't know what is happening. It's very clear given in the updated return that you cannot file an updated return unless you have a tax payable. But somehow today, if you file an updated return, you can file an updated return for no tax payable also. There is a possibility. I've seen so many of my vendors who were not filing updated, who had not filed returns. And so we were deducting taxes under 206 AB, 20%. And so we went to them and we told them, you have not filed your returns. What those idiots did, they went and filed an updated return with no tax. And they gave me the form and they came and said, we have filed a return, give me no tax now. And I'm like, Dave, how the hell did you file an updated return? That is illegal, first of all. Because tax itself is, cannot do it. Sorry? There should be a tax payable. No, tax payable is zero. I'm not saying net tax payable. Normal tax payable itself is zero. There was no refund. Now return file pan liye. The person was not filing returns, people. He suddenly what he did, he filed a return with changing the tax payable with zero. Basically, he put himself in rebate bracket. He chose new regime, chose 7 lakh ka rebate, and then he said no tax payable. Filed an updated return where? And he submits the return to me and comes and says, I've satisfied conditions, therefore don't deduct 20% for me. I'm like, this updated return will get void ab initio later on. Because there is no tax payable itself. Tomorrow assessing officer will pick him up for assessment because that's what the provision says. The provision says the moment you file an updated return, assessing officer has to pick you for assessment and do an assessment in 12 months. And when he picks up the assessment, he'll come and say, how the hell did you file a return with no tax payable? Enik the loss ache? Yes or no? Which means that day return will become void ab initio. And that day what the assessing officer will come and say? This guy never filed return, which means Rahul deducted less TDS, which means Rahul will now be sent a notice for doing what? For short deduction of the past years, along with interest. Problems and problems and problems. Fun about income tax. Never stops in life. Yes or no? Yes or no? Anyway, this is what the provisions is. As we discuss, we will discuss. Yes, these are all the nitty-gritties which you will understand along with me. This is what the fun part of the sessions are. Yes, when you know things, you don't know what is wrong with it. We will discuss what is wrong also. Yes, anyway, coming back to 115 BAA and BAB, these are what the conditions are, people. These are what the conditions are. You will have to satisfy all these conditions. Understand all these conditions given here are only for BA, B. There is no conditions for BAA. There is only one condition in BAA, which is don't claim the benefits. Don't claim the benefits. The second thing in BAA is BAA does not have a restriction on when you have to file return. It can come, when you have to opt for the BAA, it comes and says the year in which you want, you can opt it. The year in which you want, you can opt it, but you will have to do it before the due date of return filing. You'll have to do it before the due date of return filing. If you have missed out the due date, then you will not get the benefits. You will not get the benefits only for that year. You can get the benefits from the next year. You can get the benefits from the next year. Clear enough? Clear enough? Yes. I'm going to take a second.
Within the bracket of before payment. First, that is not advised return.
First return meaning original return, obviously. Nothing contained in the section shall apply unless the option is exercised by the person in the prescribed manner on or before the due date specified under 139(1) for furnishing the first of the returns of the income of the previous year relevant to the assessment year, commencing on the day after 1st April 2020, and such option once exercised shall be applying to subsequent assessment years. But aren't you liable to file a return for the first year?
Because I have not commenced my business. Get started. But and one more thing is there is Indian commencing all of the. I have not commenced manufacturing operation in the first business itself. Second and third business, I have not manufacturing.
So it's like you're coming and saying I've incorporated a company, but I'm not going to file any returns.
Even if I'm filing returns, publishing the first of the returns of income for any previous years.
Correct.
They haven't done that the first previous year. So the moment you file return, you will what if you have the returns? Say what if you have some small expenses?
Put money in FD, get interest income. You will have to put your money somewhere, no?
Keep the government for you would have invested some expenses.
He's going to call all those expenses as preliminary expenses and come and say it's not commencement income. See, that's where the whole funny thing is. The thing is, I'll be very honest. I'm a company guy right now. I was in a Big Four earlier. I'm a company guy right now, and if an advisor comes and tells me that previous year is a comedy which they want to play with me, I will not give them job. Right? I'll be very honest to you. Right? Because you come and tell me that I've created a company, but I will not file any returns because my previous year has not started, is a very, very thin line of difference. Right? Because it also gives an opportunity to the assessing officer to come and say that if you have not filed a return when you are supposed to file a return, he can make you liable for prosecution also. Right? So this is a very, very thin line of difference where you're really asking me to take a risk. And as a company, I would not like to take that risk. Right? Because prosecution is not an easy joke. Yes. The provisions in Income Tax Act come and say that if you are supposed to file a return and you have not filed a return and your tax payable is more than 3,000 rupees, you are liable for a prosecution for all your directors. Right? Now, you as an advisor may come and tell me that Rahul, your previous year has not started because you have not started your business and all those things, which is good to hear. It's all magical to hear. But tomorrow if an assessing officer catches my directors and puts him in jail, I am not going for anything else. Right? So as a company, I would not like to take that chance, people. I would like to file my returns, no matter what you call. And if I'm going to file my returns in the year in which I'm incorporated, then yeah, in all honesty, you are definitely going to be opting for the returns. Yes. In all practical sense, while you may agree from an income tax perspective that previous year starts from the date of setting up, I don't think assessing officers understand that nitty-gritties. Assessing officer will come and say that if you're going to create a book and you're going to get it audited, that is good enough as a commencement. Yes, and the moment you do that, which means you have to file your returns. So you cannot come and tell me that Rahul, my books will get audited as per Companies Act, but in income tax I will not file returns because my previous year is not satisfied. Very, very I would say it's a very risky position you're taking. I know there are some advisors playing around with this and trying to make fun of life. Be very careful. Be very careful because you're really putting your clients under risk for that. It's not. Where does it say in the year of come? No. It just says you should commence manufacturing before 24. They didn't say that you commence only, you'll get the deduction. They just say that you have to incorporate after 19, you should commence before 24. That's what I said, right? So you can commence, basically if you commence in 2019 but you never started manufacturing, you would still be eligible for 115 BAB. It is just that you'll have to prove it to the assessing officer that you will eventually get there. I don't think anywhere in the section that it comes and says that you should only file the return after you satisfy conditions. That's what I meant, basically form only. It doesn't come and say anywhere that you should file the form only when you satisfy the conditions. It just says that you should file the form on the first of the returns.
Of any previous, for any previous, when can I have multiple income? Only when I file a revised return.
Correct.
Saying original return you should claim the.
Yeah, that's what I said. So you should claim the original return benefit.
I don't get a benefit, I can still do the same.
I don't think so. That's how it reads. At least not to my understanding. Maybe you're breaking the law into some different interpretation, and I know your company would have done it differently. But if I read it on a plain simple English, it looks like the year first you filed the return, I should claim the option. That is what I'm reading, at least, right? Now, if you read it differently, I don't know. But I think you're just playing with the numbers.
they have given any previous year relevant to assessment and after first year.
Yeah, because that is the year in which the law was brought in. Right? So, I mean, yeah, let's. Good thing to explore. If you ask me as a faculty, I would not encourage that. As a professional, see, I would definitely not encourage that, because yeah, it's those small things you play around with that screws up consultants, clients' life. Yes, and then you earn money out of it, but we are ending up in jail. So yeah, I'm not doing it, definitely. At least if a person comes to me and gives me these things, I am definitely coming and saying, I'm sorry, I think I don't want you as my advisor. Let me find another person who can talk my English. Right? Just being thought about it, nothing else. Obviously, yeah. See, that's a way of looking at it, right? The point is, neither I am wrong, neither you are wrong. It's all about how you go to the court and how I go to the court. If I go to the court, I'll play it differently. If you go to the court, you play it differently. If tomorrow you win the case, then yeah, you are really a big shot person, because you made magic of what never people thought about. Might as well, let's do it. Yeah. Awesome. Great. Now, if I have to give you the tax rates of 115 BAB people, this is a little critical for your exam perspective. What are the tax rates which are given under 115 BAB? They are coming and saying, first thing, if you are under an income for business of manufacture or production and research and distribution related thereto, meaning any item relating directly to the manufacturing, tax rate will be 15%. Tax rate will be 15%. Second, they're coming and saying that, Rahul, any other special tax rates which you have, like 112A, 111A, 112, all those things will continue to be at their own rates. There will be no change in those rates. There will be no change in those rates. Things become a little complicated from here. Here is where they're coming and saying, Rahul, if you are under an STCG on a transfer of a capital lesson on which no depreciation is allowable, if you understand there are 4 kinds of capital gains. 112A will be taxed at actual rate. 112 will be taxed at actual rate. 111A will be taxed at actual rate. Brings me to the STCG others. Income tax is coming and telling, do one thing. Take the STCG others and split it into two. Tell me which of the items on which you can claim depreciation and which of the items you cannot claim depreciation. If you cannot claim depreciation, it means the asset is not used for business purposes, in which case I should not give you the benefit of 15%, and therefore I will revert back to 22%. I'll revert back to 22%. But if you are claiming an short-term capital gains on an asset on which you have claimed depreciation, it means the asset was used for business purposes, and therefore I'm reverting back to 15%. I'm reverting back to 15%, because then I can come and say that the income was derived from business activities. Or at least selling of business activities. Yes, that brings me to the last one, where they come and say, Rahul, if you are going to derive any income which is neither incidental nor anywhere related to the manufacturing, like FD interest, then guarantee commission. Acha, you are given guarantee to your holding companies. Okay, fair enough. Guarantee commission. Then speculation, like I said, no. The problem with speculation is that it ends up becoming a speculative business. The moment you call it speculative business, you violated all the conditions. And if you violated the conditions, I'm not giving you 115 BAB itself. Very risky to do any F&O transactions in a company. Don't do it. Yes, I'm talking about cases where you're renting out your building to be taxed under HP. If you are owning the building, and if you are subletting the building, then it is OS. All those items will become taxable at the rate of 22%, but the asterisk mark comes and says that it will be taxable at 22% flat, meaning no expenses are granted to you. Yes, here is where the question comes up. Rahul, imagine I have a building which I let out to another person for rent, will be taxed under HP. Now, for those who remember the format of HP, you have GAV minus municipal taxes arriving at NAV minus 30% minus interest on loan. Yes, now I know very clearly interest on loan not allowable, municipal tax also not allowable, but does this provision also cover 30%? Is the interpretation to the extent that I should tax 22% on the GAV, or I can come and say that 22% of the GAV minus 30%? Because understand, 30% is a notional deduction. It's not an expense. Because the provision comes and says when you tax, you should not allow any deduction of any expenses. This is not an expense. This is a standard deduction. And therefore there is an interpretation of thought where they come and say that if you want to tax it, you can tax it at 22% minus 30% bracket also. Although in all honesty, if you put it in an income tax return, they will tax full 22%. They will not give you the 30% ka benefit. But it's a room of thought. Because 30% which was granted to you was never a deduction of expenses. It's never a deduction of expenses. It is a granted benefit from income tax side, and therefore I am still permitted for it. I am still permitted for it. Again, a room of thought. A room of thought. Clear?
In the 30% we take, earlier we were telling that instead of granting you other expenses, water charges, this, that, etc., I am giving you a flat.
See, that's a way of talking, right? Now that is how you and I understand it. Where we're coming and saying that instead of granting you other expenses, I'm granting you 30% deduction. But at the end of the day, it's not like given in income tax that I'm giving as an alternative. When it's not given as an alternative, I have an option to tell that it's still eligible. Come again? 70 rupees. 70 rupees. On that, you'll do 22%. See, it's not technically set as gross basis. The provision simply comes and says the person will be liable to tax at the rate of 22% without allowing any deduction of expenses.
What's the general difference between an allowance and
I see the problem is in income tax, allowance is not defined. The only thing which is defined in income tax is expenses, right? So if you tell me that you're going to use the word allowance, reduction, I think it's all jargons. For me, the idea is very simple, that I am looking more at the expenses part of it, right? And if you come and ask me, is it an expense? I would still say no. True. See, here's the thought. No, that's what the difference is. The difference is about telling what the law wants and what do you read out of the law, right? It's one way to read the law and it's one way to read between the law, right? Now, I'm not telling you that I'm talking the right thing. I'm not telling you that I'm talking the right thing, but I'm telling, is there a way of defense? Yes, right? Can a person defend that, yes, I would like to tax 22% on the 70% of the revenue? Probably yes, because it is not a deduction of expenses, right? And therefore, I can still grant you the benefit. I'll give you a very simple example, people. There was this very famous thing which was there in ICI, in inter-syllabus. In inter-syllabus, what happened is, there is this provision called clubbing of income. Yes, and in the provisions of clubbing of income, you have this concept called minor child. And the provisions come and say that when you club the income of a minor child, you have to grant an exemption of 1,500 per annum. 1,500 per annum. A question came in ICI inter-syllabus where what they did is they told that the minor child has earned winning income, casual income. Minor child has earned casual income. Yes or no? Yes. Now what is happening? The minor child's income is going to be clubbed in the hands of parents. So the winnings was 1 lakh rupee. The winnings was 1 lakh rupee to be taxed in the hands of parents at the rate of 30%. That is what the idea is. Yes, but at the end of the day, if you realize, because the minor child income is clubbed in the hands of parents, you have to also grant a benefit of 1,500. Which means ICI now gave in two school of thoughts. ICI came and said, one school of thought, winnings come and say that you should tax 30% without allowing any expenses. Without allowing any expenses, and therefore you should tax 1 lakh ka 30%. Interpretation number two, ICI itself came and told 1,500 is not an expense. It is granted deduction. It is a granted deduction or an expenses exemption, and therefore you can claim it. And therefore they told that you will tax at 98,500 at 30%. Same interpretation, people. Yes, at the end of the day, the 1,500 which is there is not an expense deduction. It's an exemption given to you. At the same time, this is not a expense deduction. This is an allowance given to you. When I say allowance, it's a standard deduction given to you. Yes, and therefore there is still a room of interpretation where I can come and say that, you know what, I can claim the 30% deduction and I would not be denied it. I would not be denied it. Again, school of thought, people. I'm not saying it is the right way to do it. The point is, since you are bringing previous year and all those things, I'm bringing this for you. Right? I'm giving you my school of thoughts so that tomorrow when you go to your clients and you can come and tell them this is also one of the options where you can try and go for an appeal and win the case and come back. Big deal. Give it a shot, right? Point is, there is room of thoughts. You can think very different things. You just have to use your head carefully and therefore the answers will come out. Yes or no? Yes. Now from an exam perspective, it is not going to be tested, but nevertheless, this is what the format is. Please be only careful about this line of part, because here is where things change. Here is where things change, where you have to be smart enough to the fact that if it's a depreciable asset, then it is 15%, and if it is non-depreciable asset, it is 22%. At the same time, please understand that for this 22%, you are permitted expenses. You are permitted expenses, but for this 22%, you are not permitted expenses. Meaning capital gains, you are eligible for expense claims, but it is IFOS income or HP income, you are not eligible for expense claims. You are not eligible for expense claims. Are you clear? Yes. Good to go. Good to go? Great. This is what the provisions are, people. I'm going to quickly show you this thing. 115BAA comes and says all domestic companies taxable at 25.168. Take your special incomes at special tax rates. Company opting will not be liable for MAT computation, which is why if you remember the golden rules I gave you, it is step 9 or step 10, whichever is higher, versus step 11, whichever is lower, because step 11 is your special regime. Step 11 is a special regime. For special regime, you will not check for MAT computation. You will take the numbers as it is. You will take the numbers as it is. Then they're coming and saying company cannot claim certain benefits or deductions. If you violate any of the conditions, then the assessing officer has the power to revert you back to the old provisions. Technically not enforceable. Technically not enforceable unless and until assessing officer plays with your life. Point number C, company opting shall file form 10IC on or before the due date of return filing, and he will be eligible to claim it, but once he claims it, he cannot claim out. And then we read 115BAB. We read 115BAB. Any doubts till here? Good to go? Good to go? Yes, let's solve some questions. I'm doing some my questions, people. There are some other questions also in special regime, but I'm not discussing it right now because those are all income related questions. You have not discussed the income related questions with me, so we are doing tax specific questions. Yes, these are all my specially designed questions. Let's see if you are able to answer it. I generally would like to put only for legends, but yeah, konjam overrides it. Yes, I'm looking at the question, people. The question says Jerry Limited, a domestic company, has been incorporated on 22nd October 2023. 22nd October 2023. Is it within the period? It is within the period. Yes. Is engaged in the business of manufacture of cheese. Manufacturing. Satisfied? Not satisfied? Satisfied. The company has purchased new machinery aggregating of 45 crores, all which are put to use before 31st March 2025. So current year I purchased new machineries and I put them to use before 31st March 2025. Your previous year. Your previous year. Jerry Limited has also entered into transactions with Nibbles Limited, another domestic company, to purchase all the machinery in cheese production of Nibbles Limited for a total value of 15 crores. So I have come and told Nibbles that I want to buy your machinery. I will pay you 15 crores for it. I will pay you 15 crores for it. The net profit of the company is given as 36 lakhs. Jerry Limited has opted for the concessional tax regime of 115BAB and has computed tax at 17.16%. However, the assessing officer passed an order contending that Jerry Limited has violated the conditions of 115BAB and hence computed taxes at the rate of 30% plus applicable surcharge and cess. The assessing officer also mentioned that the Jerry Limited will not be eligible to opt in to the concessional tax regime for AY 25-26 and all the subsequent assessment years. You are required to discuss the validity of the conditions of assessing officer. Will your answer be different? And Nibbles is a US based company and the assets were purchased from Nibbles being directly imported from US. Directly imported from US. Two different questions, people. Question number 1 comes and says I have purchased 45 crores worth of assets. I have purchased 45 crores worth of assets in the first year or subsequent year? In the subsequent year, in the current year, PY 24-25, meaning it is not the year of formation. It is not the year of formation. In the same year, I have also purchased 15 lakh worth of assets from Nibbles Limited, which means my total purchase is 60 lakhs. My total purchase is 60 lakhs. Here is where the condition is. Assessing officer is saying you have violated condition. You have to tell whether he is violated or not violated. What do you think?
Assumption is total assets is 45 only in the company. Oh, sir, now 45 is the old new machinery. It's the company purchase.
It says company purchased new machinery for 45. Violated, not violated? Because sorry? So what?
It's coming up to 25 and 20 by 20%.
You will do 15 by 60. Yes, my total value of machineries are 60 crores, out of which second-hand machinery is 15 crores, and therefore I have purchased second-hand machinery of 25%, whereas I'm only permitted for 20%. In that case, violations of conditions, and therefore assessing officer is partially correct. Very good. Why? Very good. Very good. Understand, even though the conditions are violated, you are denied from claiming 115 BAB, you are still permitted to claim 115 BAA, and therefore the contention of assessing officer that you will not be eligible for any concessional regimes is wrong. The maximum he can do is he can say you violated condition and go for 115 BAA. 115 BAA. Yes or no? Yes. How do you write this in exam, Rahul? What is the answer?
Conditions.
As per provisions of section 115 BAB. The company shall not
Use.
the company shall not use plant and machinery which has already been used in India for more than 20% of the total value of plant and machinery. In the present case, the total value of plant and machinery is 60 crores and the used plant and machinery is 15 crores, which derives to 25%, and therefore the conditions are violated. In such a case, the conditions of 115 BAB cannot be availed, and therefore the assessing officer is right. The assessing officer is right. However, the contention of the assessing officer that the assessee cannot claim any concessional tax regime is invalid, since even on violation of conditions of 115 BAB, Jerry Limited can opt for 115 BA. Right? There is no conditions violation in that section. What is the conditions in that section? Yes, that is what your answer will look like. Sorry? Definition of 225A. Section 2, clause 25A. India basically covers all the landmass along with territorial waters, along with special exclusive economic zone up to 200 nautical miles, the airspace above, the land below, and the water underground with subbed, sea soil, and all those things. Landmass of India is defined in Constitution of India. See, if you come and ask me, China is asking the whole India is their part only, right? Because then tomorrow they'll come to Chennai and they'll come and say we will now become Tamilians. Yes. So technically India's landmass is defined in Constitution of India. Yes, that's where the whole condition comes out from. Clear? Clear? Yes. This is what the answer to part number 1 is. Now if you read part number 2, the part number comes and says, will your answer be different? Nibbles is a US based company and assets purchased from Nibbles are directly imported from US. Will the answer change? Because the answer would undergo a change, because any assets imported from outside India will be treated as new plant and machinery, and therefore there are no second hand machineries being used in the business right now, and therefore the conditions are satisfied. Therefore the conditions are satisfied. Clear enough? No doubts? Good to go. Let's see if you answer question number 2. No, we are doing question number yeah, we'll do all these questions later on. Question number 3, people. It says Santa Limited is incorporated on 25 October 2023 as an wholly owned subsidiary of Banta Limited and is engaged in the business of manufacturing of automobile engines. It furnishes you the following information for the year ended 31st March 2025. You have a net profit from the manufacture and sale of engines of 26 lakhs. 26 lakhs. People, I always have a practice that before I start reading the question, I always look for what do you need from the question? What do you need from the question? So I'm going to jump all this and I'm going to do the last part. It says compute the tax liability of Santa Limited, assuming that the company wishes to exercise the option of 115 BAB, which means they're asking me what is the tax rates. They're asking me what is the tax rates. Let's keep that in mind. I'm coming from the top. You're going to look at and tell me what is the tax rates. Net profit from manufacture and sale of engines 26 lakhs. 17.16%. 17.16%. Next, it included in the above net profit from the sale of 500 engines to Happy Limited, another wholly owned subsidiary of Santa Limited, at a price of 30,000 per engine, whereas the normal selling price to unrelated parties is only 28,000 per engine. So they're coming and saying if I would have sold it to someone else, I would have sold it for 28,000, whereas I'm now selling it for 30,000, which means I'm trying to keep more profits in Santa Limited. I'm trying to keep more profits in Santa Limited by entering into transactions with my closely connected persons. Income tax comes and says if you enter into such transactions, the excess profit will be taxed at, which means this is not right. This is not right. You need to first find out what is my excess profit number. which means, Rahul, what is going to happen? I'm going to split my 26 lakhs into two. One, I'm going to say 16 lakhs will be taxable at the rate of 17.16%, and then 10 lakhs will be taxable at the rate of 30 plus 10 plus 4, 44%. 34.944. He does. But then understand, there is also this interpretational thought where you can come and say if the number, see, numbers are very small here, right? If technically this number was a more than 20 crores, I would have applied transfer pricing provisions, in which case I would have to do a transfer pricing report. And if I end up doing a transfer pricing report, you will itself take a voluntary disallowance. I understand what you're saying. This is educational, right? This is not from examples. I mean, yeah, it's more to drive home the point what is happening, right? You can always make that thoughts, but yeah, just for your understanding of the question, nothing else. No, definitely not. The good thing about transfer pricing is there is nothing right in transfer pricing. Yes, it is all theoretical where you can come and say it is 28,000. In transfer pricing, you can come and say it is actually 35 there also. Yes, a person who voluntarily makes a disallowance in transfer pricing is the most stupidest person in life. I am giving an open statement to you. Yes, if any assessee in the world comes and says that they are going to make a voluntary disallowance in transfer pricing, tell them that they are not qualified as a CA. They can surrender their degree and get lost from there. Yes, never to do a transfer pricing adjustment is the only policy in life. You can always justify people. There is 101 ways to justify transfer pricing is arm's length transaction. Never have to worry about it. Yes, which is why what happens is assessing officer will also play his own games. We will also play his own games, and never you will get a right answer. There has never been a case, at least I have gone through, the transfer pricing has come with a clean order. Never. Because assessing officer will always come and say you are doing something wrong, I will also do something wrong, let's both fight. And then you have to go and file an appeals only. Yes. Voluntary, never make a disallowance, people. Most ugliest thing to do in life. Okay? Yes. Anyway, 16 lakhs with 17.16 and 10 lakhs with 30 plus 10 plus 4. Next. During the year, Santa Limited received the following assets from Banta Limited. What are the assets he's received? One, he's received equity-oriented funds. Then he's received a debt-oriented funds. Then he's received a vacant land of WDV of furniture used in the business on 1st April 2023, and then a factory building of 11 lakhs. These are all the assets which he's received from old company, which means these are all second-hand assets. Now you have a problem. You need to check whether it is satisfying the 20% bracket. It is satisfying the 20% bracket. Nevertheless, they have come and told you that the cost of acquisitions are 3.2 lakhs, nil, 7.2 lakhs, 2.6 lakhs, and 11 lakhs. Now, if you understand, these are cost of acquisition of old company, cost of acquisition of old company, which has been given to the new company under a transfer. Now, if you understand the question says Banta Limited is 100% holding Santa Limited, which means it's a transaction between holding and wholly owned subsidiary. A transaction between wholly and wholly owned subsidiary. When we do capital gains, I will tell you that when you do a transaction between wholly to holding owned subsidiary, any transaction is not regarded as transfer, meaning it is not taxable for capital gains, but you have to satisfy the condition of 8 years. Second, the cost of acquisition for the new owner will become cost to the previous owner. Cost of acquisition of new owner will become cost to previous owner, meaning all these will be treated as the cost of Santa Limited. Will be treated as cost of Santa Limited. They have also given you the year of acquisitions, people. The year of acquisition is 22, 23, 19, 20, 24, 25, 18, 19, and 17, 18. 17, 18. Yes or no? Yes. Why am I giving you the cost of acquisition, people? Income tax also comes and clarifies that when the transaction is not regarded as transfer, the period of holding of the new asset will also start from period of holding of the previous owner. Period of holding of previous owner. Why am I doing all this? You'll know by now. We'll do some questions. Yes. Next, profit of the building was let out for a rent of 35,000 per month for November to March 2025. Municipal taxes is paid in respect of said building of 13,000 rupees. Whatever building you got from Banta Limited, you have decided to let out and get a rent out of it. Question: conditions violated, not violated? Not violated, because it's not my business to rent out buildings. It will be taxable under the head IFHP. It will be taxable under the head IFHP at the rate of 22% plus 10% plus 4% on gross level on gross level. Now, to be very honest to you people, in my book, I have not claimed 30% reduction. I have not claimed 30% reduction because it's room for thought. It's room for thought. Yeah. Yes. I don't want to print a book to you and give you that you have to claim 30% reduction. Then you come and screw me later on. So I am being very safe. Yes. Next. Definitely. Nothing is given. It's assumed that GAV is equal to NAV.
Assuming it's let out, what will be the return of this empire? Let or not let.
You were the owner from when? November. You are the owner from November. When did you get the assets, ma? Solliya. Sorry. On November.
It's like I don't have to calculate that break.
You would have to ideally, but in finals you don't have to. Because IFHP is not a part of syllabus. Yes. Next. Land received from Banta Limited, which means I had two things I received. One is called building, one is called as land. Building I let out for HP purposes. Land I have. I'm coming and saying the land received from Banta Limited was let out on a lease for a period November to Feb 25 again for 20,000 per month. Land leveling charges are given as 15,000, which was incurred before the land was let out. Leveling charges did not give rise to any future economic benefits, meaning it's a revenue expense. This land was subsequently sold in March 2025 for a value of 9.3 lakhs. Expenses incurred in connection for the sale is 0.2 lakhs. Two transactions are happening. One, I'm letting out the land. Second, I'm selling the land. The letting out of land will be taxable under IFOS. Will be taxable under the head IFOS at the rate of same 25.168% on gross. At the same time, I've also sold the land. Which means there is a capital gains under either 112 or normal. So which means you need to know whether the asset is long term or short term. Look at the land. When did I buy the land? I bought the land in 24-25, meaning current year only the Banta Limited brought. Current year itself he gave it to me, and current year itself I sold it off, which means asset is less than 24 months, which means asset is short term in nature, which means it is short term others. And I told you short term others in the you have to split, check whether it is depreciable or non depreciable. This one is because it is a land, therefore taxable at 25.168, which means STCG will also become taxable on 25.168% on net value. Correct. Next. The following assets were received from Banta Limited were also sold in the month of March 2025. Whatever assets I received, equity oriented funds I received for 3.2 lakhs. I've decided to sell it for 6.3 lakhs. I sold it with an expenses for transfer of 0.3 lakhs. It was of Banta. Because he transferred as wholly owned subsidiary, it now becomes the cost of Santa also. Because transaction is not regarded as transfer. Yes. So what is my cost of acquisition, people? My cost of acquisition is 3.2. My sale price is 6.3 minus 0.3, which means now I need to check whether it is a long term or a short term asset. When did I buy the equity oriented funds? 22, 23. When am I selling it? 24, 25, meaning more than 12 months. This is equity oriented funds, therefore it is more than 12 months. LTCG under section 112A at the rate of 12.5% exceeding 1.25. Understand, people, all sales are happening in March, which means post 23rd July. Next, units of debt oriented funds. I bought it for nil. I'm selling it for 3.9 lakhs. Period of holding is more than current year amendment. Any debt oriented funds will always be treated as short term capital gains. Will not be classified as long term in nature. Any debt oriented funds, any unlisted bonds any unlisted securities, any specified mutual funds which is completely having debt orients in it will always be now treated as short-term capital gains. Section 50 AA, irrespective of period of holding. Section 50 AA current, it's basically last year's amendment along with current year amendments also. We will discuss in capital gains. Therefore, this asset now becomes fully short-term, which means again it is 111A or others. This is a debt-oriented fund, which means it is others. Again, depreciable, non-depreciable. Non-depreciable will be taxable at 25.168 at net value. 25.168 at net value. Finally, they are coming and saying you have a furniture and fixtures which is bought on 1st April 21. Cost of acquisition is given as 2.6 lakhs. Cost of acquisition is given as 2.6 lakhs. Purchase price on 1819. I bought the assets on 1819, which means on 1st April 21, I'm giving you the opening WDV. I think it is not 21, sorry, it is 23. This is 24, 25, right? Yeah, sorry, this is 24 then. My opening WDV on 1st April 24. How much is the value? 2.6. I'm selling it for 4 lakhs minus 0.1 lakhs. Hey, understand Rahul, I'm selling this for 4 lakhs and expense for transfer 0.1 lakhs. I purchased the asset in 2018-19. Period of holding is more than. Depreciable assets are always short-term capital gains. Depreciable assets are always short-term capital gains. Section 50A. Section 50A, which means this will also be taxed at short-term. This will also be taxed in short-term under 1.1. Others, under others, the only thing is this is a depreciable asset and therefore will be taxed at 17.16%. Will be taxable at 17.16%. I basically try to cover everything, people. Yes, so that you can answer everything better. Question says compute the tax liability of Santa Limited for assessment year 25-26, assuming company wishes to opt for exercise the option of 115 BAB. Now understand, company says they wish to exercise the option of 115 BAB, meaning you need to first check and tell whether it is eligible or not eligible. What are the conditions, people? Domestic, manufacturing, satisfied. Next, should not be formed by splitting up or reconstruction. I am making an assumption it is not. Because I am not getting business transfers. I am getting only selective assets. Next, should not use old plant and machinery. Tell me, Rahul, what is my plant and machineries? Have I purchased any by myself? Is there any asset purchase from my side? No, which means everything which I have right now is old. I bought assets for 3.2, 7.2, 2.6, 11. 2.6 and 11. These are all my old assets. My new assets are 0. Correct? No. My new assets are 0. These are all my old assets, which means I've violated conditions of 20%, which means 115 BAB. 115 BAB. Yeah, ma. 115 BAB. Eligible because you should not use 20% of plant and machinery. First asset is investment, second asset is investment, third asset is land, not plant and machinery, fourth asset is furniture, different block, fifth one is building, different block, plant and machinery is not obtained, which means no violation of conditions are satisfied. This is the question which Mana was asking people. Understand, the conditions come and say he should not use 20% of plant and machinery being old. This is again a small subtle difference. When they use the word plant and machinery, they refer to the block of plant and machinery. Which means any asset which does not form the part of the block of plant and machinery is still eligible to be purchased. Even if it is completely second hand also, it is okay because it is not forming part of the block. Which means if anywhere they would have used the word vehicle, computers, office equipments, books, all these items would violate conditions. All these items would violate conditions because they are plant and machinery. This is not plant and machinery, and therefore conditions are satisfied. Conditions are satisfied. A very, very small difference in the act, but makes a huge impact. Please understand the conditions continue to be satisfied if you have purchased anything other than plant and machinery being in second hand, which means one of the loophole mechanisms which I normally tell my people is that if you want to take over another company, take over everything else except for plant and machinery. Take over everything else except for plant and machinery, and then you go for it. If you want to take over plant and machinery also, no problem. Do one thing. Move at a very nominal price. Like I said, 100 crores, sell it for 1 crore. 100 crores, sell it for 1 crore. What will happen? Old company will continue to claim depreciation. New company will claim depreciation only on 1 crore, which means they will still show more profits and pay lesser tax. And you will purchase other assets, which will obviously be more than 20%, and therefore you will continue to satisfy conditions. See, that is the power of provisions. I don't know what do you mean by 20% of value of plant and machinery. They never came and told it should be actual value. It can be 20% of value as per my acquisition price also. It can be at what price I want. Don't sell it for more than 20 crores. SDD provisions apply when your transactions exceed 20 crores. Meaning? Purila. Why would I export machinery? Hey, that and all is too much. That is only when you are going to be satisfying SDD provisions, right? Which means if you do transactions less than 20 crores, no one is going to ask you anything. A to B. That is only for excessive expense. This is not expense. They are all capital expenditure people. They are not expenses. 40A to B comes and says that where an assessing officer understands that there is unreasonable expenses debited to P&L, it should be disallowed. There is no debit to P&L. This is not an expense. People, there are ways to avoid taxes. No, where do you treat it as loss? He's anyway going to disallow it, right? It's a capital expenditure. Rahul, that's what means. What will you do? You will put it in the P&L, disallow it in the PGBP, which means anyway it is not going to be allowed. Why would you care about what is happening in company's P&L? You put whatever you want in company's P&L. How does it matter? In income tax, what are you going to do? You're going to disallow, which means nothing is going to happen for that person. He's anyway disallowed the whole expense, and he is going to reduce what? Only 1 crore from the depreciation schedule, which means he'll end up claiming 99 crores ka pura depreciation. That is what provision says. And then I will end up only offering 1 crore ka plant and machinery, claim depreciation on 1 crore, get all the assets, satisfy all the conditions, life is sorted. The only thing which you'll have to be careful is to ensure that he does not come and say it is reconstruction or splitting up. As long as you can satisfy that part of the logic, everything else is satisfied. Okay. It's not. Understand, Manav, you're disallowing 9 crores in what? PGBP schedule. But the 9 crores, what is going to happen in the depreciation schedule? How much did you reduce? You'll eventually get it, no? Timing difference is not a big deal. Are you getting it right? As compared to selling the whole thing to the new company, and he will also do the same thing. What will he do? He will also claim it over the years only. Might as well you claim it. At least you're getting a depreciation at a 25% rate, whereas he's getting depreciation at 15% rate. Better to keep it in your company than his company. You will end up expending more 10% tax. Right? These are all ways, people. You can do what you want. There is no hard and fast rule to anything. I have another strategy altogether. We'll do it in PGBP. Yes, in another strategy, we'll completely sell everything in the business. And both company will claim depreciation on the same asset. He will do all those also. There is a very big loophole in PGBP where what happens is if you end up selling all your assets to another company, The old company will also claim depreciation. The new company will also claim depreciation, same asset. You will not sell all the assets. You will keep one asset and give everything else as gift. The stupidest part of PGBP chapter is PGBP chapter comes and says when you have all the assets in the block, when you have all assets in the block and you give it as a gift, you give it as a gift. The cost of acquisition in the hands of new owner is WDV of the old owner. But in my PGBP depreciation schedule, what I can reduce is only sale value. My sale value is 0. Where will you pay tax? Sorry? One of the worst amendments brought in. I'll tell you, one of the worst amendments brought in because now I'm additionally claiming losses also.
Corporate gifting is not.
When you said corporate gifting is not allowed, you came and told me it is to be taxed under capital gains. What is my consideration? What is my cost of acquisition? You will end up in a short-term capital loss now. I am keeping one asset in the block, which means you cannot move to capital gains. You can only move to capital gains when the asset ceases to exist. My block is not ceasing to exist. Think about it, people. 100 crores worth of assets I have. 100 crores worth of assets I have. 10 machineries I have. 9 machineries I'll give it off for gift. My asset is now showing 100 crores. I will claim depreciation on 100 crores. My block is still there. My block is still there. PGBP provision comes and says when you get a gift from an old owner, WDV is WDV to the old owner, which means he will also come and take my asset as 100 crores. Which means same assets, 2 different people using, but both are getting 100 crores depreciation. Did you violate any condition? You satisfied everything. Correct? No. Correct? No. This is one of the what do you say, M&A transaction I had given in my Big Four when I was working as an article. The only problem is managers, no. Rahul, you should not promote tax avoidance and you're an article, maybe you don't understand logics and everything, this is wrong, that is wrong, and armature. I'm like, okay, get lost, you take care. He didn't take it, simple. Yes, one of the most worst drafting of laws, I tell you. Yes, technically there should have never been a provision which comes and says it should be WDV of old owner. They should have come and said it is the price at which the old owner sold it. It is the price at which the old owner sold it, you would have got no extra benefits. Now double deductions are coming. Yes or no? All these things we learn. PGBP Pakmo. Yes, when you do PGBP, that time you'll have a lot of fun. Yes, right now this is what the provisions are. Clear? Yes. Now people, since we are doing this question and if it comes in exam, you need to write all the theory. Yes. Before even you start computing taxes, the first thing which you need to tell is first whether the conditions are being satisfied or not. Yes or no? Yes. Can we write it down? Yes. Question number 3. Question number 3. This is your chapter number 2. This is your chapter number 2, special tax regime. Under that, section number D, question number 3. Chapter 2, section D, question number 3. Yes, people, when I give you the printout of the solutions guide, you will be able to put the page numbers and all. Right now, yeah, it's a little difficult. These page numbers are subject to change. Therefore, I'm not giving it to you. Yes, because I'm yet to add additional questions from study material, and therefore these questions are subject to change. Once I give you the copy of printout, that time you can add your page numbers in it. Yes. What are we doing? We're doing question number 3. What is it? Computation of tax liability. Computation of tax liability of Santa Limited. Under section 115 BAB. Under section 115 BAB for the assessment year 25-26. People, I'm showing you how the format in exam looks like. Follow formats. Yes, formats carry marks in exam, so please be mindful of formats. Yes, computation of tax liability of Santa Limited under section 115 BAB for the assessment year 25-26. For the assessment year 25-26, what we'll do is we'll leave some lines. Let's leave some lines and let's write the notes, and then we'll put the answers on the top. Yes, so maybe leave some around 15 lines. Leave around some 15 lines. Note. What is the first thing you'll write, people? first check for eligibility of 115 BAB. Yes. So the first thing is note number 1. Note number 1, eligibility under section 115 BAB. Note number 1, eligibility under section 115 BAB. People, what and all conditions are we looking at? From the question, what and all conditions can you see and satisfy yourself? Incorporated after 2019, has commenced manufacturing, then the plant and machinery valuations are satisfied. Next, assume that splitting up and reconstruction is not taking place. Next, obviously. Next, what else? Very good. The person has not entered into any other business because the sales which he's made, the rents which he's receiving is not part of his business. These are the 5 conditions you'll have to satisfy in order to be eligible for 115 BAB. Yes, yes. Eligibility under section 115 BAB. Under that, Santa Limited is eligible to claim. Santa Limited is eligible to claim the benefits of section 115 BAB. Santa Limited is eligible to claim the benefits of section 115 BAB since Santa Limited is eligible to claim the benefits of section 115 BAB since, put 2 dots and come down, point number 1. Put 2 dots and come down, point number 1. Since Santa is a domestic manufacturing company. Santa Limited is a domestic manufacturing company incorporated after October 2019, incorporated after October 2019, and has commenced manufacturing before 31st March 24. It has commenced manufacturing before 31st March 24. Point number 2. What is it? What others we had? What are the other things we told? Santa Limited is not engaged in any business other than manufacturing. Santa Limited is not engaged in any business other than manufacturing. Full stop, continue. The lease of land and factory building. The lease of land and factory building are taxable under IFOS and IFHP respectively. IFOS and IFHP respectively. Thus, no conditions are violated. Are taxable under IFOS and IFHP respectively. Thus, no conditions are violated. Point number 3. What is point number 3? Santa Limited has not taken over. Santa Limited has not taken over any second-hand plant and machinery. Santa Limited has not taken over any second-hand plant and machinery, and thus no conditions are violated. Full stop, continue. All assets from Banta Limited do not form part of plant and machinery block. All assets from Banta Limited do not form part of plant and machinery block. Plant and machinery block. Point number 4. Point number 4, it is assumed that the acquisition from Banta Limited, it is assumed that the acquisition from Banta Limited, does not constitute what? Splitting up or reconstruction of business. Does not constitute splitting up or reconstruction of business. Splitting up or reconstruction of business. Full stop, continue. Full stop, continue. Even if the condition is violated. Even if the condition is violated. Even if such conditions are violated, such transfer took place only in FY 24-25. Such transfer only took place in FY 24-25, which is not the year of formation. Very good. Which is not the year of formation. So I'm basically coming and saying, the condition satisfy aglanalo prachna illa because it is not the year of formation. Therefore, I'm still beneficially eligible. Done. This is your basic conditions. Let's go back to the top. Let's compute our taxes. Let's put the columns, people. What and all columns do you need? Particulars, amount column, tax rate column, and then tax. Yes, because the tax rates are changing, it is better to have a tax rate column also. Yes, so it is particulars, big column. It is particulars with big column, then an amount column, then rate of tax, and then finally tax number. Yes, particulars, amount, percentage of tax, finally tax. Yes or no? Yes. Let's start from the top. First item which you see is point number one. What? Profit from sale of engines. When the rates are changing, it doesn't matter. Profits from sale of engines. Within bracket what? Excluding excessive profits. Profits from sale of engines within brackets, excluding excessive profits. Amount is 16 lakhs. Percentage is 17.16. Give me the tax number. Drop the numbers, it's okay. It is 274560. 274560. Next, point number 2. What is it? Excessive profits from Happy Limited. Excessive profits from Happy Limited. Show the computation, people. Show the computation. What is the computation? It is 30,000 minus 28,000 into 500. Show the computation, people. In exam, all these are important. Don't assume numbers. ICI wants to know how did you find the numbers. So please show your computations. Put it in the particulars itself. It is 30 minus 28 into 500. Therefore, your amount becomes 10 lakhs. Your amounts become 10 lakhs. Percentage of taxes 34.32. It is 30 plus 10 plus 4. So therefore 34.32. Number is 3,43,200. 3,43,200. Then done. Next, what other items do you have, Rahul? You have, let's ignore capital gains for now. We'll go to rentals. Next, point number 3. What is it? rent from building, rent from factory building, rent from a factory building, rent from a factory building. What is the number? What is the number? It is 20 into 5. Why 35? 20 தானே இருக்கு. Oh, sorry. Okay. I'm reading the wrong thing. Right. Sorry. 35 into 5. 35 into 5. Number is 175. 1,75,000 will be taxed at the rate of 25.168. Will be taxed at the rate of 25.168. Will be taxed at the rate of 25.168. Number is 44,400. 44,044. Acha, 44044. 44044. Come down. Note number 2. Note number 2. What are you going to write? What are you going to write? Why? How do you write this? See, you don't write that for all the questions. What do you write?
That is not relating to manufacturing.
Very good. Point number 2. Since letting out of factory building, and land, I know da. Since letting out of factory building and land are not incidental to manufacturing operations. Since letting out of factory building and land are not incidental to manufacturing operations. These will be taxed at 25.168%. These will be taxed at 25.168% without allowing. These will be taxed at 25.168% without allowing any deduction or allowances of expenses. Without allowing any deductions or allowances of expenses. Yeah. Now write the numbers. You done? Achha, you wrote the tax, sir. Okay. Point number 4. What is point number 4? Leasing of land. Point number 4 is leasing of land. How much is the number? 1 lakh. 20,000 into 5. 4 Feb. Okay. 20,000 into 4, 80,000. 20,000 into 4, 80,000. Your tax rate becomes 25.168% and the tax becomes 20,134. 20,134. Done? Yes, this leaves you with capital gains. Now, because capital gains is a little complex, we'll do it in a separate page. Note number Patra. Note number 3. Computation of capital gains. Note number 3. Computation of capital gains. People, how many assets are we selling? 4 assets.
4.
I'm seeing 4 assets. Equity, debt, furnitures, land. So it is particulars with 4 columns. Hey, from next class, my small request, people, please carry a pencil and a scale. Get used to it. In exams and all, if you write very haphazardly and the numbers are flowing into different columns, it look ugly. Yes, so please carry a pencil and a scale. It is a good practice to always put a line. Yes, I don't want you to color and everything, but a small line will do. At least you can keep it in the same length. Yes, so please carry a pencil and a scale. It'll be good for you. Particulars with 4 columns. What are the 4 columns, people? Equity, debt, furniture and land. Equity, debt, furniture and land. Equity, debt, furniture and land. Yes, under that point number 1. Point number 1, nature of capital gains. Point number 1, nature of capital gains. Nature of capital gains. Look at equity, people. Nature of capital gains will be when did you buy? 22, 23. When are you selling? 24, 25. More than LTCG under section 112A. LTCG under section 112A. LTCG under section 112A. Debt. Always short-term capital gains. Always short-term capital gains within bracket 50 AA. Within bracket 50 AA. Third one. Always STCG. Always STCG. Section 50A. Always STCG section 50A. Fourth one. Land is also STCG because period of holding is less than 24 months. Period of holding is less than 24 months. I'm not sure how many of you are aware about it. From the current year, there is no 36 months. There is no 36, everything has become 24. Yes, we'll discuss in capital gains. Yes. Then come down. Come down, come down, come down. Full value of consideration. Full value of consideration. Numbers are, throw the numbers, people, quickly. 6.3, 3.9, 6.3, 3.9, 4, and then 7.2. What is 9.2? Acha, it's here. 9.3 then. 9.3. Yes. So it is 6.3, 3.9, 4 and 9.3. Yes. Less expenses on transfer. Less expenses on transfer. Less expenses on transfer. Numbers are 0.3, then 0, then 0.1, then 0.2, 0.30, 0.1 and 0.2. What is the number? What is it called as? Net consideration. Net consideration. Get me the numbers. It is 6 lakhs, 3.9 lakhs, 3.9 lakhs, 9.1 lakh, 9.1 lakh. Less cost of acquisition. Ideally we would have put indexed also, but amendments, less cost of acquisition within bracket. In this question it is anyway not there, solra. I know, I prepared the question that way only. Now podumodhu apdi dhaan prepare panna because I didn't want to complicate it. Yes, less cost of acquisition within bracket. Within bracket, cost to the previous owner. You have to clarify where are you getting the numbers from. Within bracket, cost of previous owner. Close the brackets. Close the brackets. Get me the numbers. 3.2, then 0, then 7.2. Sorry, 2.6, है ना? 3.2, 0, 2.6 and 7.2. 3.2, 0, 2.6 and 7.2. 7.2. Yes. Yes. Get me the capital gains. Get me the capital gains. It is 2,80,000, 3,90,000, 1,30,000, 90,000. 1,90,000. 1,90,000. Done. Done. Yes. Yes. Next line. Next line. Rate of tax. Next line. Rate of tax. First one. Rate of tax is 12.5 in excess of 1.25 lakhs. 12.5 in excess of 1.25 lakhs. 12.5 in excess of 1.25 lakhs. Next. Rate of taxes. People, depreciable asset, non-depreciable asset. Non-depreciable. Therefore, it goes for 25.168%. Therefore, it goes for 25.168%. Now, I'll be very honest to you. When I prepared this question, I had a personal doubt. Because this is a non-depreciable asset, you are going to tax it at 25.168%. And the provision comes and says if you're going to tax it at 25.168%, you're not eligible for any expenses. Yes. Now, I had a personal doubt that when you're going to tax it under capital gains, also does this rule apply? Also, does it rule apply? If yes, then what would happen? The debt-oriented funds would have become zero on cost. Another school of thought may come and say, no, it may be eligible because it is capital gains and not a normal income. To be very honest, I don't know the answer. And therefore, I chose to put it as zero. Because if I put a number there, then I'm giving an opinion to you. I don't have an opinion.
For example, that's they're saying that they have special capital gains, then they have to say ABCD, say they are special.
That is only when it is special income. No, this is not a special income.
No.
See, that's what the problem with Income Tax Act is. Income tax comes and says when you are under STCG others, it is technically not a special income itself. It is as good as calling it a Finance Act income, right? And when you start calling it as a Finance Act income, then yeah, in all practical sense, you don't even have to call it capital gains also. You can just say it as an income. And the moment you do that, then a ruling comes up to say that whether you can claim expense or not claim an expense, right? I'll be very honest, I don't have the answer. Therefore, debt-oriented fund is showing cost of acquisition as zero. If there was a number there, should you claim it or should you not claim it? I'm not sure. The most conservative opinion would be to not claim it. Yes, another aggressive position can come and say it is not an income, it is a gains. And therefore, I would still be eligible for it. I don't know the answer, therefore I did not put it. Let me be very honest to you about it. Yes, it's a thought to make. You can figure it out. What is the rate? 25.168. Luckily in this question there is no expenses, so 25.168 directly is the number. Next, third one. Furniture will be taxed at 15%. Let's put 15 right now. Let's put 15. Taxable at 15%. Fourth one. Land with no depreciation will be taxable at 22%. Now, combine everything. Kila plus 10 plus 4 na podunga. You have put the base rates. You have to put the surcharge and cess. So, overlap all the columns together and say plus 10% surcharge plus 4% cess. Plus 10% surcharge plus 4% cess. Plus 10% surcharge plus 4% cess. Done. Come down. That's all. Table is over. Note. Table is over. Just 2 lines, people. Small note. Since Banta Limited is the 100% holding parent of Santa Limited, since Banta Limited is the 100% holding parent of Santa Limited, all transfers between Banta and Santa, will not be regarded as transfer. Under section 47. Will not be regarded as transfer under section 47. Full stop, continue. Thus the cost of acquisition and period of holding of Santa Limited the cost of acquisition and period of holding of Santa Limited has been what? Taken as that of the previous owner. Has been taken as that of the previous owner. Has been taken as that of the previous owner. I'm just putting out all the provisions, people. You need to write all the provisions for your exams in order to fetch your marks. Yes? Yes? Great. More than? You will get short-term capital loss. You'll have to make an assumption around it. Because see, you cannot do it that way, right? You have to then know what is the SDV of the price also. What are you saying? I don't understand. 47A comes and says that the new person who gets the asset should not let go of the assets within a period of. Yeah. Which one? All the ones. Why IFOs? Do you know what the stamp duty value is? If that was given, that's a different conversation. Only if you are given the stamp duty value. Only if you are given the stamp duty value, then you would have done it. But in that case, the cost of acquisition also would have modified, right? The point is, I wouldn't do it because the stamp duty value is not given. Regardless. No, if the transaction is so if the transaction is not regarded as transfer, section 56(2)(10) also comes and clarifies that any transaction other than gifts which is not regarded as transfer will not be taxable under IFRS also, right? So in your case, if 47A was satisfied, then you would have looked for 56(2)(10). If 47A is not satisfied, then you would have not looked for it. Yes, because the provisions come and say 56(2)(10) may that any transfer under section 47 except for 47(1) which talks about gifts, 47(1) or 47(2). That's what basically what clauses they mentioned is all clauses except for 2. Basically they mentioned all clauses except for 47(2). So they're coming and clarifying that all clauses except for 47(2) will not be regarded as IFRS income, right? And so therefore this also will get satisfied that you won't have to tax it under IFRS. Yes, yes, you already have the tax rates. Compute the numbers, put it on the particulars column. Put it in the particulars column, people. Point number 4, 5, 5. Point number 5, LTCG under 112A. LTCG under 112A, you have the amounts, you have the tax rate also. Get me the answers. What is the income? 2.8 lakhs. So what will you do? 2.8 minus 1.25 into 12.5%. Into 12.5% plus 10% plus 4%. Numbers are 2, 20 to 165. 20 to 165. Check, people. Matching. Next. STCG. STCG. What is the amount? Debt to 3.9 lakhs into 25.168. Number is 98,155. 98,155. 98,155. Point number 3. Again STCG on furnitures at the rate of 17.16. 22,308. 22,308. Last one is LTCG, STCG. STCG on land. STCG on land number is 1,90,000 into 25.168 47819 47819. Yes, people, I'm reading out all the tax rate numbers once again. Check if it's right. First one is 17.8 tax rate numbers. 274560 343200 44044 20134 22165 98155 22308 47819. Total the numbers, people. 872390. 872390. This is the exact number, or you rounded off? 385. Please bear in mind, people, you have to round off. Please bear in mind, you have to round off. If you don't round off, they'll cut out the mark. Cut out the mark. So please always round off. Please always round off. People, done. Yes. Again, not an exam related question, but a comprehensive question for you to understand everything going on in 115 BAB. Yes, this question basically tackles all the kind of answers you may have in the questions, some good knowledge for you so that you can revise it once again. Yes, please go back home, people, and look at this question once again. Also go back and read 115 BAA and BAB only to the extent of tax. Don't read the exemptions and deductions or the brackets. That we will discuss subsequent classes. Read only till page number go ahead and read till page number 19. Go ahead and have a revision till 19 from the first chapter, people. From the first chapter till 19, if you can just quickly go through and come for tomorrow's class, it will become easier for us. Yes, so take it up to that. Let's do question number page number 19. In tomorrow's class, we will start with a smaller topic of cooperative society and everything. Try to complete our special tax regime and then automatically move on to our review. We'll move on to our review, and then finally second half of the class we'll be doing mostly PGBP. I'm not interested to do unexplained income and agriculture. We'll do it later. We'll move on to PGBP in the subsequent class. Yes, people, tomorrow you have a class till 1. You have a class till 1, so I'm not planning to start at 6:30. Is it okay if we start at 7? Or you want to go a little later at 7:30 also? 7 is okay? 7 is okay? Yes. Let's do 7 to 1 and then we'll have a break in the middle also. Yeah? Yes. Please prepare and come till 19. We will do some better things in tomorrow's classes. We will also revise this once again, but if you also prepare and come, it will be easier for you to also recollect with what we are doing. Yes? Yes? Thank you, people. Have a good weekend.